Hi, greetings from Ravichandran from the Mountain Path, the world of finance. So, this session we will discuss hedging with futures, estimating the optimal number of contracts for hedging. So, when it comes to hedging, what is exactly hedging with futures? Hedging is a risk management strategy used to offset potential loss in investment by taking an opposite position in a related security. So futures contracts are commonly used for hedging instruments that allow investors to lock in prices. So the whole purpose of derivatives is to lock the prices or price guarantee. Now we should understand when do you take a long position in futures, when do you take a short position in futures. Let us quickly take some examples. Let's say you are about to buy an asset in future. So what is the risk of the exposure? The increase in the price of the asset in the near future is a risk. So how do you hedge? You take a long position on the futures contract of the relevant asset, and thereby you are protecting against the possible price increase in the price. You are trying to lock the price. You have a price guarantee to purchase the asset at a predetermined price. Let's say you already invested on the asset. You are taken a long position on the asset. Now, what is the worry? The decrease in the price of the asset or the loss in the value of the portfolio is the issue. So how do you hedge? You take a short position in futures contract. Thereby, you have the right to sell and the futures contract and at the predetermined price. So even if the asset price falls, you can and buy at a lower price. You can make profit. So the loss in the value of the underlying asset will be offset by the profit that could be gained in the futures position. Similarly, if you are exporter, you expect foreign currency and to be credited in your account later. So what is the exposure and risk? The foreign currency value depreciating. So how do you hedge? You take a short position on currency futures or forward, thereby locking in the current exchange rate for conversion. Similarly, when you are importer and you are receiving foreign currency, and you are paying foreign currency. That means the foreign currency appreciating is a risk. You take a long position and thereby locking the current exchange. So I just given some examples of what should be the hedging strategy when you use futures. So our main discussion is and how many contracts are required for hedging. So once you know the positions for how to use the strategy, we should know how many contracts are required. So in this we have three situations. Let's say your futures contracts are directly available for the asset that you have the exposure. That means you can directly calculate the number of contracts by taking the value of the position divided by the notional value of one futures contract. When you say notional value of one futures contract means lot size into the futures price. Okay. Let's say that the underlying asset where you have exposure, where you don't have any direct futures contract available in the exchange. So how are you going to do with this? That's what our main discussion today. So you have to calculate minimum variance hedge ratio multiplied by the value of the asset exposed divided by the notional value of the contract. We're going to discuss that. Let's say you have a portfolio of asset. In those situations, how do you hedge? Use index futures and how many contracts are required for hedging? You calculate portfolio beta into value of the asset exposed divided by the notional value of one futures contract. You take some examples on these three scenarios to calculate the optimal number of contracts. Especially in the second scenario, where there is no direct futures available and we have to calculate what is called and the minimum variance hedge ratio. So this concept is called cross hedging. Cross hedging is a hedging strategy when there is no direct futures contract available for the specific asset you want to hedge. Instead, use a futures contract for a different but a correlated asset to reduce your risk. Let's quickly go into the first situation. The first situation is where you are having a long position on a stock or an asset, and that means the it, so let's take this example. Let's say an investor has invested 10,000 stocks, bought ITC stocks at 420. So his overall value of the portfolio is 42 and lakhs. Now, let's say that he wants to hold on the comes for 1 month, let's say the current futures price is 418.35 with a lot size of 1600. So the notional value of the futures contract is 6,69,000. Now you want to find out the number of contracts and optimal number of contracts required for hedging. So it's very simple, and the value of the portfolio and divided by the notional value of one futures contract. So roughly around 6 contracts will be required to take a short position on this since the investor has taken a long position. Let's take the second important scenario when the cross hedging, when there is no direct futures available, so you have to use a concept called minimum variance hedge ratio. The formula for the minimum variance hedge ratio is we call it as H star, the standard deviation of the asset prices divided by the standard deviation of the change the price of futures into correlation. So let's assume some data. Let's say we have some 20 months data is available, and let's say the asset prices is available and the alternative futures price also available. Let's quickly calculate the returns of these assets and the futures price. So we calculate the standard deviation of the asset and similarly the standard deviation of the futures prices changes, and we also calculate the correlation. So H star is can be calculated as and a correlation into and the asset prices standard deviation divided by the and future standard deviation, that is roughly 0.86. Now, so you are using this. Now, once you know, let's say that an investor has got 50,000 shares and the current value is 142.3. So the notional value of his investment is 71 lakh 15,000. Now you want to calculate the number of contracts required. First calculate and the large size. Let's assume the large size of futures alternative versus is 1000, bought it at 95.2. So the notional value of one futures contract is 95,200. Now, the optimal number of contracts is very simple. So that means minimum variance hedge ratio into portfolio value divided by and the one notional value of one futures contracts. So roughly you get 64 and contracts and to be hedged. So number of contracts, optimal number of contracts required is 64, and basically the optimal number hedge ratio accounts for the imperfection in the correlation. So in this situation, and the correlation is and 98, somewhere 98.1. So that means it accounts for the imperfection in the correlation and the volatility differences between the asset price and futures. So the purpose of hedge ratio to address the imperfection and in the correlation, since it is not exactly 1, it's 0.98. And let's take the last scenario here. Let's say investor has taken a long position of portfolio of assets. Let's say he has got 4 stocks: ITC, Infosys, State Bank of India, Tata. Okay, let's say he has bought this. This is the price at which he's bought and number of shares. So you take calculate the value and calculate the weight of and each stock in value, and you have the beta that is given by the market. So calculate weighted beta and the portfolio weighted beta. So you got the portfolio beta is roughly around nearly 1. So now let's say that he wants to hedge using the Nifty index futures. First calculate what is called the notional value of the futures contract. So let's say the futures contract Nifty is 25,098, large size is 75, and the notional value. So whenever there is a portfolio of stocks, so he has to choose a corresponding index. He cannot choose one each stock futures, so that will be very expensive. It's very difficult. So instead, he can choose a appropriate index. In this situation, we have taken Nifty 50 as an index. So once you know the notional value of one futures contract, you already calculated portfolio beta. So the number of contracts for hedging is simple: portfolio beta into the value. So very simple, the portfolio beta multiplied by and the value of the investment divided by notional value of one futures contract. So the roughly around the optimal number of contracts for hedging is 4 contracts. So we discussed today this session, and so what is the how do you hedge using futures contract? So what are all the and long and short strategy we'll use in different position? And the main purpose is to calculate the number of contracts, futures contracts required. So when the direct assets are available, you can directly calculate value of the position divided by notional value of the same asset futures. When there is no direct futures contract available, we calculate minimum variance hedge ratio, and by calculating the correlation standard value of the futures and other assets. Now, when the portfolio, when somebody has invested in a portfolio of assets, so we use index futures. That's what we discussed. So in index, whenever you want to calculate number of contracts, is simply the portfolio beta into the value of the investment divided by the one futures notion. But when it comes to minimum variance hedge ratio, the approach is to calculate standard deviation of the change in the asset prices, standard deviation of the change in the futures prices, correlation between these asset prices that comes as 0.86. So the formula is very simple. The number of contracts, optimal number of contracts required is, and the minimum variance hedge ratio multiplied by the value of the investment on the assets divided by notional value of the alternative asset futures contract. So the roughly it comes 62. So thank you for watching. Hope this is very clear.